and Namaskar. The Monetary Policy Committee met on 5th, 6th yesterday, 7th today of this month. You are all aware that the Governor's statement after the MPC meeting contains the resolution of the MPC with regard to the policy rate and stance. It also contains announcements and measures which have a bearing on the monetary and regulatory policies. The Monetary Policy Committee resolution is of course of interest to a large number of people from various walks of life. It impacts the lives of virtually all citizens of the country. The resolution also provides the rationale and the thought process of the MPC and therefore is of relevance to businesses, economists, academicians and the finance world. Apart from these MPC-related announcements, the Governor's statement has become an important medium for the Reserve Bank to highlight its priorities on which it would like its regulated entities to focus their energies on. It is an opportunity to point out areas of concern and challenges for the stakeholders to address their attention to. It is an occasion for the Reserve Bank to articulate its views on critical areas of interest. I will continue with this practice of a detailed statement after each MPC committee meeting. Now, before I come to the resolution of the MPC, kindly allow me a moment to reflect on the experience of the flexible inflation targeting framework. You are all aware that this inflation framework was put in place in the year 2016 and it was reviewed in the year 2021. You are all also aware that this is a monumental change in the monetary policy history of our country. And so I thought it fit that I reflect on the experience of the flexible inflation targeting framework. Well, I believe that it has served the Indian economy very well over these years, including the very challenging period since the pandemic. The average inflation has been lower post the introduction of this framework. Moreover, CPI has mostly stayed aligned with the target given under this framework, barring a few occasions of breaching the upper tolerance band since its inception. We in the Reserve Bank and the Monetary Policy Committee will continue to improve the macroeconomic outcomes in the best interest of the economy, using the flexibility which is embedded in the framework, while responding to the evolving growth inflation dynamics. Moreover, we will strive to further refine the building blocks of this framework by making advances in the use of new data, improving nowcasting and forecasting of key macroeconomic variables. We forecast, you are aware, growth, inflation, etc., because this is actually a forward-looking policy. And so we'll continue to do that and develop more robust models. On the regulatory front, I would like to mention, and especially there has been a lot of media attention with regard to some of the proposed regulatory changes pertaining to liquidity coverage ratio, expected credit loss framework for provisioning by banks, the prudential norms governing projects under implementation. We will continue to strengthen, rationalize, and refine the prudential and conduct related framework. I think this is very important in the overall interest of our economy. The interest of the economy demands financial stability and consumer protection. Our mandate in the RBI is to enhance both of them. At the same time, I would like to emphasize that the economic interest also warrants increasing efficiency in the economy, and this too is our duty. We recognize that just like there are no free lunches, regulation to enhance stability and consumer protection, too, is not devoid of costs. There are trade-offs between stability and efficiency. We will keep this trade-off in mind while formulating each and every regulation. It will be our attempt to strike the right balance, keeping in view the benefits and costs of regulation. I also want to reassure all stakeholders that we will continue with the consultative process which the RBI has been doing over the years in this regulation making process. The suggestions of the stakeholders are very valuable, and we will continue to give serious consideration to them before taking any major decision. We will also ensure that the implementation of such regulations is smooth. We will give sufficient time for transition, and where regulations have major implications, the implementation will be done in a phased manner. Coming to the global economy, the global economic backdrop remains challenging. The global economy is growing below the historical average, even though high-frequency indicators suggest resilience, along with continued expansion in trade. Progress on global disinflation is stalling, hindered by services price inflation. With receding expectations on the size and pace of rate cuts in the US dollar has strengthened, bond yields have hardened, emerging market economies have witnessed large capital outflows, leading to sharp depreciation of their currencies and tightening of financial conditions. Divergent trajectories of monetary policy across advanced economies, lingering geopolitical tensions, and elevated trade and policy uncertainties have exacerbated financial market volatility. Such an uncertain global environment has posed difficult policy trade-offs for emerging market economies. The Indian economy, though continuing to remain strong and resilient, also did not remain immune to these global headwinds, with the Indian rupee coming under depreciation pressure, as you would have noticed in the recent months. At the Reserve Bank, I would like to assure all of you we have been employing all tools at our disposal to face the multi-pronged challenges. With this backdrop, let me now come to the Monetary Policy Committee resolution. As I mentioned, we met these last 3 days, concluding today. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook, as I mentioned, we are forward-looking, the MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. I repeat, the MPC unanimously decided to reduce the policy rate by 25 basis points from 6.5% to 6.25%. Consequently, the standing deposit facility, SDF, the SDF rate shall be at 6.0%, and the marginal standing facility rate, also called the MCF rate, and the bank rate shall be 6.5%. The MPC also decided unanimously again to continue with the neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. I shall now state the rationale for the decision in brief. The MPC noted that inflation has declined, supported by favorable outlook on food and continuing transmission of past monetary policy action. It is expected to further moderate in 2025-26, gradually aligning with the target. The MPC also noted that though growth is expected to recover from the low of Q2 of 2024-25 this year. It is much below that of last year. Last year, you are all aware, it was 8.2%. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. And accordingly, the MPC decided to reduce the policy rate, by 25 basis points to 6.25%. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. With this, now I come to the assessment of growth and inflation. First of all, growth. As per the first advanced estimates, real GDP growth for the current year is estimated at 6.4%. The numbers were released by MOSPI recently. This is a softer expansion after a robust 8.2% growth last year. Going forward, economic activity is expected to improve in the coming year. Agricultural activity remains upbeat on the back of healthy reservoir levels and bright Rabi prospects. Manufacturing activity is expected to recover gradually in the second half of this year and beyond. Early corporate results for Q3, and we have more than 50% of the results now as we speak. It indicates a mild recovery in the manufacturing sector. Mining and electricity are rebounding from monsoon-related disruptions in Q2. Business expectations remain upbeat, as evident from the PMI Manufacturing Future Output Index. Services sector activity continues to be resilient. PMI services, however, declined from its recent peak. On the demand side, rural demand continues to be on an uptrend, while urban consumption remains subdued, with high-frequency indicators providing mixed signals. And we are aware, we got the Nielsen survey report also just yesterday. Going forward, improving employment conditions, tax relief in the union budget, moderating inflation, together with healthy agricultural activity, bode well for household consumption. Government consumption expenditure is expected to remain modest. Higher capacity utilization levels, robust business expectations, and government policy support augur well for growth in fixed investment. Continued buoyancy in services export will support growth. Global headwinds, however, continue to impact uncertainty to the outlook and pose downward risks. Taking all these factors into consideration, the RBI has estimated that real GDP growth for the next year to be at about 6.7%, with Q1 at 6.7%, Q2 at 7%, Q3 at 6.5%, and Q4 too at 6.5%. The risks are evenly balanced. Coming now to inflation, headline inflation, after moving above the upper tolerance band in October, has since registered a sequential moderation in November and December, standing at 5.2% now. Going ahead, food inflation pressures, absent any supply side shocks, should see a significant softening due to good Kharif production, winter easing as we witness every year in the vegetable prices, and a favorable Rabi crop prospect. Core inflation is expected to rise but remain moderate. Rising uncertainty in global financial markets, coupled with continuing volatility in energy prices and adverse weather events, presents upside risks to the inflation trajectory. Taking all these factors into consideration, CPI inflation for the current financial year is projected at 4.8%, with Q4, the current quarter, at 4.4%. Assuming a normal monsoon, CPI inflation for the financial year 2025-26 next year is projected at 4.2%, with Q1 at 4.5%, Q2 at 4%, Q3 at 3.8%, and Q4 at 4.2%. The risks are evenly balanced. I will now come to the external sector. India's current account deficit moderated from 1.3% of GDP in Q2 of last year to 1.2% in Q2 of this year, 24-25. According to the World Bank, India, with an estimated inflow of $129.1 billion US, continues to remain the largest recipient of remittances globally last calendar year 2024. The current account deficit for this year is expected to remain well within the sustainable level. As on 31st January, this year, I may inform you, India's foreign exchange reserves stood at $630 plus billion US. This provides us an import cover of more than 10 months. Overall, India's external sector remains resilient as key indicators stay robust. I would like to mention over here, and especially because there has been commentary in the media about the Reserve Bank's exchange policy. Well, the Reserve Bank's exchange rate policy over the years has remained very, very consistent. Our stated objective is to maintain orderliness and stability without compromising market efficiency. The Reserve Bank believes in the market efficiency of the markets that we have in India for Forex. Accordingly, our interventions in the Forex market focus on smoothing excessive and disruptive volatility. It does not target any specific exchange rate level or band. The exchange rate of the Indian rupee is determined by market forces, and we will continue with this policy. Coming now to liquidity and financial market conditions, I may state that after remaining in surplus from July to November 2024, system liquidity as measured by the average net position under the liquidity adjustment facility did turn into a deficit during December 2024 and January 2025. This drainage of liquidity is mainly attributed to advanced tax payments in December 2024. You are aware there are quarterly advanced tax payments to be made, December being that particular month. For the advanced tax payments for Q3, that did have an impact. Capital outflows, again, one has witnessed some capital outflows because of various reasons. Forex operations and a significant pickup in currency in circulation as we witness every year in January. It has been, however, I would like to mention over here that we have observed that some banks are reluctant to on-lend in the uncollateralized call money market. They are passively parking funds with the Reserve Bank. I take this opportunity to all the banks to urge them to actively trade amongst themselves in this uncollateralized call money market, so as to make it deeper and vibrant for better signal extraction from the weighted average call money rate. The Reserve Bank is committed. I want to assure everyone that the Reserve Bank is committed to provide sufficient system liquidity. We have taken a number of steps in this regard, and we will continue to monitor the evolving liquidity and financial market conditions and proactively take appropriate measures. I repeat, proactively take appropriate measures to ensure orderly liquidity conditions as may be required for the system. And when I say liquidity, it means not only transit overnight liquidity, but also durable liquidity to meet the requirements of the system. I now come to financial stability. The system level financial parameters for the scheduled commercial banks continue to be healthy. The credit deposit ratio for the banking system at the end of January 2025 was at 80.8%, broadly similar to that on 30th September 2024. Bank liquidity buffers are sufficient, though the net interest margin moderated, return on assets and return on equity are robust. The system level parameters for NBFCs too are very healthy. I also take this opportunity today to mention that the Reserve Bank has been observing Financial Literacy Week annually since 2016. This is with the purpose to enhance financial education in our country. Last year too we did this campaign. This campaign was focused last year on empowering youth adults. This year, recognizing the critical and multifaceted role of women in society, this campaign will emphasize on women's role in financial decision making and household budgeting. I sincerely urge all banks to actively participate in this campaign on the theme Financial Literacy, Women's Prosperity. It starts from 24th of this month. Now, before I conclude, I shall be announcing some additional measures. Necessary directions and circulars for these shall be issued separately. First of all, on digital security, the rapid digitalization of financial services has brought convenience to all of us, at the same time efficiency, but it has also increased exposure to cyber threats and digital risks, which are again getting sophisticated day by day. The surge in digital frauds is a matter of concern. It warrants action by all stakeholders. The Reserve Bank has been taking various measures to enhance digital security in the banking and payments system. Introduction of additional factor of authentication for digital payments is one such measure. It is now proposed to extend this to online international digital payments made to offshore merchants who are enabled for such authentication. Second, the Reserve Bank shall implement the bank.in exclusive internet domain for Indian banks. Registration for this domain name will commence from April this year. This will help avoid banking frauds. This will be followed by the fin.in domain for the whole of the financial sector. The banks and NBFCs, I would urge them to also continuously improve preventive and detective controls to mitigate cyber risks. They must develop robust incident response and recovery mechanisms, reinforced through periodic testing for operational resilience. Third measure that I am announcing today, over the past few years, we have expanded the suite of interest rate derivative products available to market participants to manage their interest rate risks. We shall now, to this suite, include forward contracts in government securities. This would facilitate long-term investors such as insurance funds to manage their interest rate risk across interest rate cycles. It will also enable efficient pricing of derivatives that use government securities as underlying instruments. Fourth, to enhance access of retail investors to government securities, the Reserve Bank has taken a number of steps earlier. There's another step that I am announcing today, and this pertains to expanding the access of NDS Home, our platform for trading in the secondary market transactions for government securities, to non-bank brokers who are registered with SEBI. A number of them are registered with SEBI. They will also get an opportunity now to participate and trade through the NDS Home, the electronic trading platform of RBI for government securities. Fifth, in view of the various developments in financial markets and market infrastructure over the past few years, we shall be setting up a working group with representation from various stakeholders to undertake a comprehensive review of trading and settlement timing of markets regulated by the Reserve Bank. There are some 5 such markets which have different timings. The group shall submit its report by 30th April this year. To conclude, considering the existing growth inflation dynamics, the MPC, as I mentioned earlier, while continuing with the neutral stance, felt that a less restrictive monetary policy is more appropriate at this current juncture. The MPC will take a decision in each of its future meetings based on a fresh assessment of the macroeconomic outlook. We are committed to conduct monetary policy and take such measures as appropriate, which are timely, carefully calibrated, and clearly communicated to facilitate conducive macroeconomic conditions that reinforce price stability, sustained economic growth, and financial stability. Thank you, Namaskar, and Jai Hind.
That was the new RBI Governor Sanjay Malhotra, his maiden policy, and yes, he has delivered as per street expectations. The first rate cut in almost 5 years, a 25 basis point rate cut coming in, although they have decided to continue with the neutral stance, and this decision as well was unanimous. The marginal standing facility and the standing deposit facility rates have been changed to 6.5% and 6% respectively. In fact, in terms of inflation, the MPC did note that inflation has declined and it is expected to moderate further, aligning to the target in 2025 itself. Now, the governor also pointed out that the FY25 CPI forecast has been kept unchanged at 4.8%. But if you look at the FY26 estimate, that stands at 4.2%. Of course, he has pointed out that food inflation is expected to ease significantly going forward due to better kharif crops, and of course, the core inflation could inch up slightly higher, but that isn't really a cause of concern as of the current juncture. But the tone of the governor suggests that he is tilting towards growth rather than inflation management. We will have a battery of experts and we will speak to them about what they think about whether or not the continuity is there, from the previous governor or not. But in terms of inflation forecast, as I said, 4.2% for FY26. For first quarter of FY26, it's at 4.5%, vis-a-vis earlier estimate of 4.6%. So it has been brought down, but for second quarter, it has been maintained at 4%. And from the third quarter onwards, in fact, inflation is expected to come below or sub 4%. So for the third quarter of FY26, inflation is supposed to come in at 3.8%. And for the fourth quarter of FY26, it is supposed to come in at, or expected to come in at, 4.2%. In terms of growth, For FY26, growth estimates, real GDP estimate is at 6.7%. For the first quarter, it's at 6.7% vis-a-vis 6.9% earlier. So it has certain adjustments have been made when it comes to quarterly growth estimates. For the second quarter of FY26, growth is expected at 7% vis-a-vis earlier estimate of 7.3%. For the third quarter, 6.5%, and for the fourth quarter, 6.5%. The Eco survey had also predicted or come out with the forecast of 6.3% to 6.8% when it comes to growth forecast. So it has been aligned, in accordance with what the economic survey projections showed. Aside of that, looking at some other comments that were made by the governor, he did feel that there is excessive volatility in global financial markets, and there are risks when it comes to global growth as well. Which is why the MPC will remain watchful, and that's why they have maintained their neutral stance, so that it allows them to make adjustments as per the global backdrop as well. Aside of that, the governor also said that there will be trade-offs between efficiency and stability, and they will attempt to strike the right balance between efficiency and stability, and they will also ensure a smooth implementation of any changes to regulations, and they will give sufficient time to adhere to new regulations as well. Just want to see what the markets are doing at the current juncture. We did see a dip coming in of 80 points or thereabouts on the Nifty. Well, right now it's it's kind of coming off the low point of the day. 23,530 is where it's at, down by 0.3%. Just want to see what the Nifty Bank Index is doing. Nifty Bank Index has fallen by 200 points, so it's at 50,150 as of now. Mid Cap Index is down almost 0.6%, so underperforming the benchmarks. In terms of how some of the banking names are doing, earlier I spotted that HDFC Bank was doing well at the open. Well, it has given up most of its gains, but it continues to be in the positive territory. But if you look at some of the other banks like Kotak Bank, SBI as well, they are all in the red as of now. The Axis Bank down 1%. So yes, I mean markets are still digesting the comments coming in from the RBI governor. Although a 25 basis point rate cut was factored in, but of course, we'll see how things really pan out. But on that note, let me bring on board our guests for today. Joining me is Vivek Kumar, economist, quant eco research, and Sunil Subramaniam, market expert. Well, gentlemen, thanks a lot for joining in. Coming to you first, Vivek, 25 basis point rate cut, first in almost 5 years. The markets were factoring that in already. But going by the tone that the governor adopted, would you say that there has been a shift from inflation management towards growth? What are your initial thoughts on the governor's maiden policy?
Hi, good morning, and thanks for having me on the show. So yes, it looks like now the RBI is incrementally turning a little bit soft as far as their assessment on the overall growth inflation dynamic is concerned. And if I have to compare between the February policy and the December policy, one thing which kind of stands out is that in December policy, the outlook on inflation was more or less unchanged, barring the fact that the current inflation number was too high. It was above 5.5%. The outlook on growth was more or less known. So while the official data for the financial year 24-25 was not released by the MOSPI, there was an expectation in the market that the full year growth for FY25 is likely to be somewhere close to 6.5%. And markets were also expecting the subsequent year growth to be almost thereabout. So in some sense, RBI is now trying to attest what was there in terms of market expectation about 2 months back, that growth incrementally is going to be in the 6.5-7% range. And going forward, inflation, with the expectation that there will be a substantial food price disinflation in FY26, the headline number should fall under 4.5% to as low as 4.2%. Our in-house expectations are pretty close. We are at 4.3% on CPI. And although we've given a band of 6.3% to 6.7% on GDP growth, we believe post the budget announcement, the GDP number is likely to be towards the higher end of 6.3, 6.7%. So yes, there now seems to be an acknowledgement that whatever room has opened up, which the governor himself alluded to, that the dynamics between growth and inflation has opened up a little bit of space, policy space, and they are now looking to use that policy space to support growth in conjunction with the union budget.
Got your point, Vivek. Sunil, coming to you, what is your assessment? Going by the governor's commentary, would you expect this rate cut cycle to be around that 75 basis point cut mark? Because the street has been factoring in a 75 basis point. Would you expect that to that to remain intact, or would you say it could be a little more shallower than 75 basis points?
I think it will be a little more shallower. I think what the RBI governor has done is taken a leap of faith. You see, the data, if you look at it from the growth perspective, for the next 2 quarters also, he's expecting 6.7 and 7. It's only the Q3 and Q4 that he's toned it down to 6.5. Similarly, inflation just for 1 quarter comes below their target of 4. Otherwise, by the year end, he's expecting that also to go up to 4.2. So I think room for additional rate cuts, I think he's taken a leap of faith. So to the extent he's kind of fast forwarded the rate cut. Pure data, I would say, did not support a rate cut. Market sentimentally was expecting, no doubt about it. But I think the pure data itself did not support a rate cut, and that I think has been a key element on the speech. And probably the market not taking it so kindly is because they are trying to read into what this means for future rate cuts. And I think so. This is done and dusted, discounted. Market had run up in the expectation, but now that's happened. But I'm not sure that the data is clearly showing a strong slowdown. The PMI numbers are both looking fairly good, though the services PMI came down slightly, but still at 56, 57, you have no cause for complaint. So I think that what he's done, he's taken into fact that food inflation is coming down. He's taken into the fact that there's global uncertainty around growth, and he's taken a leap of faith, which is an excellent thing. And I think is aligned with the government's fiscal policy, the monetary policy. All these are very great. But I think over cuts this year, I think it will be shallower.
Sure, shallower rate cut, perhaps 50 basis points. That's the view from Sunil. But Vivek, do you think a CRR cut was also warranted given the liquidity deficit that we have seen? With the recent 1.5 lakh crore announcement, do you think that would cover up the liquidity deficit, or do you think more needs to be done on a durable basis? I think you're on mute, Vivek. If you can unmute yourself.
I hope this is good. So again, this
yes,
seems to be like
please go on.
This seems to be like a nuanced question, because we'll have to take into cognizance what RBI did in December as well, as far as liquidity is concerned. And between December till date, the RBI has infused almost 2.5 lakh crores of liquidity. So we are also including the CRR cut, which was announced in December. And this seems to be inadequate vis-a-vis the drain on liquidity which has been seen on account of largely, I would say, FX operations, because temporary tax outflows you should ideally not count, because it goes out from the system and also comes back into the system with a lag of 2 weeks or so. So the key driver of change on the liquidity front is RBI's FX operations, and we've lost nearly more than $80 billion of spot reserves. So the drainage that has happened on account of RBI's FX intervention has been more than 4 lakh crores, whereas RBI has supplied just about 2.5 lakh crores of liquidity. So we've filled in the gap, but only about 50% of the gap. So there's still a lot of scope left to replenish that liquidity gap. And we had expected some sort of an action on liquidity, whether it was coming through the NRI deposit route or whether it was coming through reserve requirement route. That has clearly not been communicated. Maybe that is something which will be an ad hoc measure which the RBI will take, because he said that he'll take them as and when necessary. The other part is obviously the fact that now with the stance remaining unchanged, so that's one part which the market was expecting. So there was going to be a rate cut according to consensus view. Along with that, the consensus was also expecting a change of stance. So since that has not happened, the future course of policy kind of now remains uncertain. So you still don't know whether April is a done deal as far as a 25 basis points rate cut is concerned or not. So had it been accompanied by a change in stance to accommodative, then probably the future course would have been slightly more easier to predict. Now you have that question mark in everybody's mind. In fact, if you look at how markets have reacted, especially the bond market, the yields have actually moved up by 3 odd basis points. So now you have that element of uncertainty, and maybe the governor also wants to hedge himself by not pre-committing anything as far as interest rate move is concerned. So early on in the global economic cycle, where you don't know what is going to happen tomorrow from the US side.
Sure, got your point. You made a very valid point. It hasn't really been accompanied with a change in stance, which is why the future of rate cuts is still uncertain, which is why I think even Sunil mentioned that the rate cut cycle will be a lot more shallower. But looking at the Nifty Bank Index, Sunil, we are at the low point of the day, and yesterday we saw SBI reporting numbers. Pressure on margins continues, multi-quarter low, right, when it comes to SBI margins. With this rate cut, do you expect margins to get squeezed further? Although SBI has said it will have minimal impact, but what's your take on in that sense? Would private banks make more sense vis-a-vis PSU banks now?
Yeah, because I don't think that they would be able to really pass on this rate cut in terms of either lending rates or deposit rates. Because as it is, the credit deposit ratio you mentioned is 80%. So there's very limited room to maneuver, and banks are not finding it easy to get deposits. So they can't afford to cut deposit rates. And if they were to cut lending rates, they'll lose, there'll be a big challenge on margins versus market share. So, and especially SBI's returns, you mentioned, a lot of the bank's results are showing the pressure at the bottom end of the thing, the unsecured loans, the microfinance, the small. So, see, that's the one which really fuels into a consumption-related boom. So, I think to that extent, from the rate cut perspective, I think that the transmission is going to be a challenge, because transmission in lending rates will come at the cost of margins. So each bank will have to take a balancing view on, do I chase those lending numbers or do I protect my margins? So yes, that element of uncertainty now in the bank strategy definitely creeps into play, right? And like you said, it's the market is also a future animal, right? The market always discounts the past and goes into the future. So the rate cuts happen. So if the future rate cuts are shallower, then that's not something that the market is looking forward to. So I think a lot, and I agree with my friend here who said that the neutral stance, right, indicates the shallowness. And so market, like I said, buy on the rumor, sell on the fact. So the bank stocks all ran up a bit in the expectation. Now it's time to book profits and wait for the future economic indicators and the April policy to really take a move. So I think it's been very, very, heightened sense of expectation from the market that not only we want rate cuts, we want the stance to be accommodative, and we want future rate cuts also to be factored in today. All of that has not happened today. Very pragmatic approach by the governor. Yeah. And like I said, actually, the data did not warrant a rate cut. If you look at pure data perspective, okay, it is the market sentiment, the government policy. So he took a leap of faith. He's aligned himself with the government and said it. But having done that now, he can't afford to say, I'll go on doing rate cuts, to support it, because rate cuts done excessively can lead to inflation from the demand side also. So he has to be cautious on that.
Sunil, I also want to ask you one thing from a consumer perspective. As you said, transmission may not happen that soon. So are home loan EMIs not going to come down that soon? Your thoughts on that?
I don't think so too. I don't think the home loan EMIs are going to rapidly fall in this context here, because home loans are the cheapest loans out in the market, right? Every other loan is priced higher than a home loan. So, as it is, they are under pressure. And even in home loans, if you look at the data of some of the housing finance companies, right, there is some challenge in terms of NPAs in our building. So the provisioning they'll have to do. Second is source of funding for the home loan companies, right, is from the banks. And they are also kind of slowing down on loans to NBFCs. So overall, I think, yes, I don't think at this point the RBI policy has done enough to force a reduction in the long-term lending rates of home loans, and hence the EMI impact. So I don't think it's going to follow through in that manner at all.
Okay, EMIs not expected to come down that soon. Vivek, let's talk about the rupee as well. While the rupee fell, 1.2% in the 10 months from Jan 2024 to November 2024, it fell an equal amount in just 5 days from Feb 1 to Feb 5th. And since the last policy, the rupee has depreciated over 3%. Now, as the interest rate differential narrows, should we expect further pressure on the rupee going forward? Also want to point out that, in comparison with how other emerging market currencies have fared against dollar, rupee is, largely or comparatively better placed. So, here on, what is your trajectory, or how are you approaching or looking at rupee movement here on? Do you expect more weakness going forward? How should we look at that?
So the rupee definitely is better placed as far as the overall macros are concerned. And when we talk about overall macros, you look at the growth momentum, inflation conditions in the economy, and both the fiscal deficit and the current account deficit. So current account deficit is going much lower than its long-term trend. Fiscal deficit is on a path of correction. In fact, the finance minister over the last 2 fiscal years, she's posted minor pleasant surprises as far as the degree of fiscal consolidation is concerned. So there is nothing major to worry. Even from a growth perspective, I think, yes, there has been a deceleration, but then clearly 8.2% to some extent was an aberration caused by statistical discrepancies in the data system as well. So close to 7% is where the long-term average growth for India lies, and we are kind of gravitating towards that. Despite the lower growth, India on a relative basis, because currency market is all about how you perform on a relative metric. So despite the deceleration, India still continues to be the highest growing major economy. So all that macro backdrop continues to be supportive of it. There's no doubt about that. However, the global situation is extremely volatile and extremely uncertain. And when you have an uncertain environment and when you are fighting against a dollar strength, dollar being the numeraire in the FX market, there is very little that you can do about it. You've already spent close to 80 odd billion dollars of reserves in the last 3 or 4 months trying to protect the currency volatility. Is there merit to do more? I think we are now slowly reducing our import cover. That's number one. Number two is the fact that over the course of last 3 to 4 quarters, rupee had also seen a lot of overvaluation creep in. So because of all the stability that we have been talking about, the Indian rupee in the last 2 years, it came at the cost of overvaluation. So the rupee was becoming more and more overvalued vis-a-vis peers. So to some extent, when the global tide turned, I think it gave the opportunity to correct that overvaluation. That is one part. Number two is obviously we did try initially with a fairly heavy hand with respect to trying to curtail rupee depreciation. Now, with the cost that we've already paid in the last 3-4 months, now the question arises, what kind of cost are we ready to bear over the course of next 3-4 months? Because the global uncertainty has just begun. Things have just started. It's just the month of February. The first round of tariffs have been rolled out. Some of them were taken back. Some still remains in the system. And next 3 or 4 months, I would say next at least 1 to 2 quarters are going to be critical as far as getting a sense on US tariff policy is concerned. So once that uncertainty is behind, till that point in time, I guess it makes sense to align with your peers. So I'll be a little bit more flexible and don't lose out on competitiveness in the process. So we would expect currency to actually keep on depreciating, at least in the near term. By near term, when we mean we have a horizon of not more than 6 to 12 months. So over the course of 6 to 12 months, we are calling for 89.5 on the rupee. And this is again largely on account of what's happening globally and our need to align with that global reality rather than trying to protect rupee from an artificial perspective.
Sure, got your point. Since we are speaking about the currency markets and the bond markets, I want to ask you about your short-term trajectory on 10-year yields as well. They did see an uptick after the RBI governor's comments. Any targets in terms of where yields are headed over the next 6 months?
I think 650 to 675 seems like a good range for yields. So I would agree with the market view at this point in time that the rate cut scope is pretty shallow. Our own in-house view is just for a 50 basis points rate cut over the course of the entire 12 months. So you don't have a lot of scope to cut rates because inflation still continues to remain above target, and there are enough risks which have crept in. Currency itself is a big risk. Almost every 5% depreciation in currency adds to about 35 basis points to your CPI inflation. So these are the risks which will have to be kept in mind. And even from a growth perspective, 6.7% growth, I think it's not a bad scenario to be in. Yes, things have softened, but it's not a crisis situation which requires a lot of monetary stimulus at this point in time. All it requires is to maybe align your real interest rates according to the lower inflation, and that gives you a space of just about 50 basis points, at max 75 basis points. Now, with that kind of a backdrop, I think the scope for bond yields to rally much is likely to be limited because we've come all the way down from nearly 730, 740 at our peak, and this has happened when RBI's repo rate has been constant at 650. So despite repo rate being at 650, we've seen bond yields drift lower significantly.
89.5, Sunil, that's the rupee target on the rupee over the next 12 months or so from Vivek. Given that, is it a good time to look at export-oriented themes, and which are the sectors that you would really look at?
So for me, basically it's got to be IT there, and so some extent pharma, because the companies that are listed in the Indian stock market, the depreciation get translated into higher EPS on a post-currency basis, right? So straight away, those are the two sectors that will benefit. But on merchandise exports and that stuff, I think the global volatility, uncertainty, the Trump tariffs, all of that have a role to play. To the extent that Mr. Modi's visit to US this month and how Trump has been silent on India as far as this is concerned. We have accepted the illegal immigrants back. We have not put, and we have actually reduced taxes on the import duties on Harley Davidson. So we are making the right moves. Now, if we are able to walk away from the monthly meeting with him with no tariffs, especially on India, and some kind of an arrangement that we'll buy some energy, oil, we'll buy some defense equipment, then this thing could pan in our favor. Then it will be a huge boost because then the substitution of China with India-related stuff can get an acceleration and the PLI will come into play. So I would wait for this month to see how that goes because Trump vis-a-vis India, he's been silent. So let's wait for that. If there's negative news, it's a different thing. But if we come anywhere close to being on a neutral basis vis-a-vis the tariff, that's a positive for exports. So in addition to the depreciation. And the other aspect is that I think that, let's bear in mind one thing, right? One is the dollar strengthening. But what has also hurt the rupee is the FII outflows, right? It's the sheer fact that RBI had to supply those dollars. He has pulled out liquidity from the domestic market to do that. And that's why our reserves have come down from 700 billion to 630. Now the events are over, right? You have had the budget which is finished. You have had the RBI policy which is finished and earnings season goes through. You could possibly see the return of some FIIs based on the fact that the market is corrected and the valuations are better. Now, if the FII flow comes back, then the question is different. Then the rupee is not going to weaken that much because those flows will provide short-term support to the rupee. So it's a very interesting period of play, I would say, that we need to watch out for.
Sure. Of course, tariff will be a wild card as far as India is concerned because till now, there has been no mention of how much tariff or if at all there will be any tariff on India. Sunil, I want to talk to you about real estate stocks as well. They have seen a sizable correction, right? The sector has been seeking interest rate cut to drive housing demand after the kind of valuation correction. Some of the stocks have seen, you would still say that in terms of risk reward, are they better poised now? Will this rate cut stimulate housing demand? And, your take on that.
Not yet. Like I said, first of all, I don't expect a big drop in EMIs because of this. Second, if you see of all the K-shaped consumption recoveries, real estate has been starkly the one. You had 10 crore plus houses selling, but the affordable housing segment has really kind of come off. And if you see the data in terms of the housing projects, they're all finding it difficult to sell the lower budget ones. And that's where EMI is very important. So I don't think the RBI policy has done enough to cause an EMI rate cut. So from a housing perspective, I would still say wait and watch. The premium developers who are selling there, I would say less of a challenge. But those who are going to the mass segment and the affordable housing segment, I would say that the costs are still too high from a customer's perspective at the affordable segment for them to trigger that. And so we'll have to wait for other positive developments on that front.
And what do you do with autos? Sales have been in the slow lane, inventories building in showrooms. Do you expect some kind of a pickup there? Because, we've also had a budget boost of, tax cuts. In light of that, how would you look at the auto space as well?
I'm positive there, because one is that as comes March, there'll be a heavy push, to claim depreciation. So all small businesses and all would advance their purchases. And typically, even the CV segment sees a huge boost of sales in March. In fact, sales get booked in April also, and as of date of March. So I would say all that inventory should get cleared with this. And definitely on the EMI on the auto loan side, right? Your consumption, the tax cut, 100,000 crores of money given in the hands of the population, I expect it to be used where the EMIs will sharply come down, as a proportion of their salary, right? So this increase in disposable income will be seen at play in the auto, and especially in the two-wheeler, which has seen a very good slowdown kind of the thing. So I think now it will trigger, because at the 12 lakh where he's saving the money, he's ideal two-wheeler customer, right? 1 lakh a month he earns, and a two-wheeler cost and EMI is within his band. So I think the two-wheeler will get a boost, and I think March will see a good clearance of inventory. So I would say that's a good out, because I'm positive on the auto space, not specifically because of any rate cut thing today, but overall because of the budget as well as the March cut year.
Vivek, I want to come to you. One more question before I take your closing comments. In terms of bank loans to NBFCs, the risk weightage was increased to 125%, right? Was there a need to revert back to 100%, or do you think that would have been a very premature move? I think you're on mute, Vivek.
Sorry. So contextualizing the
Please
hike, it was actually not a hike per se, but more a restoration of what used to exist from a regulatory standpoint pre-COVID. So in some sense, it was getting back to the pre-COVID levels of regulation as far as some of these rates were concerned. So the moot question again is, should we relax it vis-a-vis pre-COVID levels? Does the economy need that kind of, regulatory forbearing even now, 4 or 5 years down the line when things have completely normalized? And maybe on the margin, it is now working on the reverse side, where adverse risk taking is being incentivized. So RBI probably is approaching it from that point of view, that the economy does not need the same kind of regulatory forbearance. And if we have to continue with that kind of regulatory forbearance, then it might cause some amount of adverse risk-taking behavior in the system. So I think it's more to do from that perspective, and a little bit of caution might be warranted in the current scheme.
What about the liquidity coverage ratio? Could there have been some easing on that front, to address the liquidity issue?
So I believe there is some pushback from a system, from the banking system as such. And as far as the central bank is concerned, looks like things will get deferred, or even if it gets implemented, it is likely to get implemented in a very staggered manner. That's something which the governor himself said, that whenever we are going to make very important regulatory changes, we'll take into account every feedback. And if it's a monumental change, then things are likely to get staggered in a wide manner. So first point is that it is unlikely to get implemented right away. Second is, even if it does, it is likely to get staggered. It is going to give enough time to the banking system to adjust to the new reality.
Yeah. Sure. And gentlemen, closing comments, expectations from the presser at 12 o'clock. Anything in particular you'll be watching out for? Sunil, let me come to you first.
Well, I think direction on regulations, because as you know, RBI has been coming heavily down on the unsecured loans in the small end of the world. So they're worried about, and you mentioned about balancing stability with regulation. So I think to that extent, the presser will give more details in terms of the micro tactics, and I'm looking forward to that because that will decide a lot of the sectoral based outlooks.
Sure. Vivek, your expectations?
I think key question would be what about stance? Why did the stance not change along with the rate cut? And two is questions on liquidity. So the system is still starved of liquidity. Even if there is a rate cut, the transmission probably is going to get hampered because of lack of adequate liquidity. So how good is the rate cut right now? And third are probably, and last but not the least, will be the focus on rupee, because rupee has been in extreme focus, extreme volatility vis-a-vis history. That's where I would expect a lot of questions to come.
All right. With that, gentlemen, would like to thank you for taking out time and joining in and putting things into perspective for us. Good chat, and I look forward to interacting again in future as well. Thank you.
Thank you so much.
Thank you. Well, on that note, that's the news from the RBI policy, a 25 basis point rate cut, first rate cut in almost 5 years, but the stance has been kept at neutral. So yes, expect a lot of questions around this in the press conference at 12 o'clock. Of course, we'll be getting you live coverage of that as well. So don't forget to tune in to Money Control for that. But for now, it's a goodbye from me. Thanks a lot for watching this special coverage on RBI policy. Stay tuned to Money Control for all your other news and updates, and keep monitoring our space for the press conference as well at 12 p.m. Thank you.